Welcome back to Investing Talk Podcast.
Today we're looking at Carvana.
As usual, before we start, subscribe, like, and comment to this video to support the show.
It is Thursday, January 29, 2026. And frankly, we have to talk about what just happened. Carvana has just come off what you can only describe as a monster year in 2025.
Monster is right. I was looking at the chart before we hit record, and the stock more than doubled last year. I mean, if you were holding this anytime in the last 12 months, you're probably feeling pretty confident right now.
No doubt.
But, and you know, there was always a but.
Yeah.
With me, we have to ask the hard question. Is this a permanent turnaround for the online auto retailer? Or is the tank running empty?
That is the big conflict right now. The market is completely split.
Because let's be honest, this company has a volatile history. It wasn't that long ago, what, 2022, 2023? That people were using the B-word bankruptcy when talking about them.
Oh, yeah.
They were the poster child for the pandemic bubble popping. So seeing them at these highs today, my skepticism radar is pinging off the charts. It feels like deja vu.
And that is fair. It's actually healthy skepticism. But when we unpack the numbers we have in front of us, you might see why the market is reacting the way it is. We aren't just looking at a stock price recovery.
Okay.
We are looking at a fundamental shift in the machinery of the business. I mean, the company that almost went bust 3 years ago isn't the same company operating today.
Okay, that's a big claim. So let's stop speculating and get into the data. Walk us through the raw numbers. What is actually driving this surge? Is it just hype, or are they actually selling cars?
It is definitely not just hype. I mean, if we look at the revenue trajectory, it is undeniable. They clocked 27% year-over-year growth in 2025.
27%.
That is significant double-digit expansion for a company of this size. But here is where it gets really interesting. Look at the third quarter of 2025 specifically.
Go on.
Their retail units accelerated by 44%. They moved 155,941 vehicles in a single quarter.
Wow.
That is a massive amount of metal moving through the system.
That is a lot of cars. But,
Yeah.
you know, selling cars is one thing. Making money on them is another. I can sell dollar bills for 90 cents all day long and have great revenue growth, but I'll go broke doing it.
Of course.
So are these revenue numbers deceptive? Are they just discounting heavily to move inventory?
And that is the key point. And that is where the old Carvana differs from this 2026 version. Their revenue actually surged 55%, hitting $5.65 billion in Q3.
Whoa, wait, pause there.
Yeah.
Revenue growth 55% outpaced the unit growth of 44%. If revenue growth is higher than unit growth, that implies they're charging more.
It means price and discipline and better unit economics.
Yeah.
They aren't just selling more cars, they are capturing more value for every single one of them. And the estimates for where we are right now for the current quarter are projecting $5.23 billion.
Right.
Looking ahead, the consensus for the full fiscal year 2025 is nearly $20 billion, and fiscal year 2026 is projected to cross $26 billion.
Those are big headline numbers, I'll grant you that.
Yeah.
But I want to talk about the bottom line. Historically, Carvana was a cash incinerator. I mean, they were building those giant vending machines, spending a fortune on Super Bowl ads. Have they actually fixed the leak in the bucket?
They have. They've shifted from cash burning to cash generating. This is the aha moment for the bulls. In Q3, their net income margin was 4.7%.
Okay.
That resulted in $263 million in net income. But if you look at operating margins, they are nearing that 9 to 10% range.
That is a drastic change from the days when they were losing money on every car sold.
It's all about efficiency. And looking at the adjusted EBITDA, which is a good proxy for operational cash flow management, is expecting the full year 2025 to land between $2.0 and $2.2 billion.
Okay, hang on. For the listeners who might hear EBITDA and gloss over, that's earnings before interest, taxes, depreciation, and amortization. Basically, it's the raw cash the business operations generate.
Right.
$2 billion in EBITDA, it's a serious war chest.
It is. And it changes the narrative completely. It means they can self-fund.
However, I need to push back on the financial health a bit more. Because while the income statement looks pretty, the balance sheet is where the skeletons usually hide.
Sure.
They generated $18 billion in revenue. Fine. But their historical leverage, I mean, they took on a massive amount of debt to survive the last few years. That debt didn't just disappear, did it?
You're right, the debt is still there, and the leverage is still something to watch. It's not a perfectly clean slate, but you have to look at the free cash flow improvement. When you have EPS, growth earnings per share, growing at 38.5% annually over the last 3 years, that debt burden becomes much easier to manage.
So they're growing into their capital structure.
Precisely. They are earning their way out of the hole, And they have built a moat while doing it.
A moat.
Yeah.
And used cars. Come on. It's a commodity business. You buy a Ford F-150 here, you buy it there. It's the same truck. How do you have a competitive advantage?
True, the product is the same, but the platform isn't. Their competitive moat is vertical integration. It's not just the website. It's the logistics network, the reconditioning centers, and specifically the ADESA wholesale auctions they acquired.
Odessa.
Yeah.
That was that huge bet they made a few years back. I remember when that news dropped, the stock tanked because everyone thought they overpaid. A lot of people thought that was going to sink them.
And instead, it's becoming their killer app. It gives them control over the wholesale market, not just retail. Think of it this way. Most dealers have to go to an auction, pay fees, ship the car, fix it up, then sell it.
Right.
Carvana now owns the auction house. They cut out the middleman. They have expanded their retail production capacity to over 1.5 million units.
Wait, 1.5 million. But you said earlier they sold around 155,000 in a quarter?
Yeah.
That's like 600,000 a year?
Exactly. Do the math. Their infrastructure capacity is 2.5 times their current sales volume. They have built the factory, so to speak, for a business more than double its current size.
So that's what they call operating leverage, meaning they don't have to build any new buildings to double their sales. Every extra car they sell now is almost pure profit because the fixed costs are already paid for.
You nailed it. That is the magic of high fixed cost businesses once they scale. And right now, they are only capturing about 1.5% of the total used car market.
So the argument is that even a small shift in consumer preference toward online buying fills that empty capacity without them having to spend billions more on infrastructure.
That is the growth thesis in a nutshell. They built the machine, now they just have to feed it.
All right, that's the business side. And I admit, it sounds much healthier than it did 3 years ago. But let's pivot to the charts, because the stock market and the business are not always the same thing.
Oh, they certainly are distinct animals.
And the price action here is, well, it's vertical. Stock is trading near the $455 to $478 rail range. That represents a 94% rally in just 1 year.
Yep.
And if you zoom out 3 years to the bottom of the crash, it's a 65x surge. 65 times your money.
It's staggering. If you put $10,000 in its bottom, you're looking at over $500,000 today. And a lot of that momentum recently has been driven by their inclusion in the S&P 500.
Right, the S&P 500 inclusion. That forces all those passive index funds, your 401ks, your Vanguard funds, to buy the stock whether they like it or not.
A guaranteed buyer.
But looking at the levels, we saw a recent pullback to around $410. To me, that suggests consolidation. It's catching its breath.
It's trying to establish a new floor.
But here's the data point that makes me nervous or excited, depending on which side you're on. The short interest.
It's high, isn't it?
It's elevated. 13.01% of the float is sold short. And that is up from 11.48%.
So despite this monster rally, people are still betting heavily against this company.
Heavily. But here is the kicker. The cover time is 2.91 days.
And explain why that matters for someone who doesn't trade actively.
So days to cover is how long it would take all the short sellers to buy back their shares, given the average daily volume. Nearly 3 days is a long time in trading. It means the door is small and the room is crowded.
So if there's good news,
If the price spikes and they all rush for the exit at once.
it creates the perfect setup for a short squeeze.
Exactly. It's a feedback loop. Earnings surprise, shorts get squeezed, they're forced to buy, which drives the price up, which forces more shorts to buy.
And we are seeing institutional flow supporting that upside. I mean, we're seeing volume surges tied to earnings optimism. Major banks like Bank of America are picking this as a winner.
So the big money is fighting the short sellers. That is always a fun battle to watch. But let's transition to how the market feels about the stock, because sentiment can be a leading indicator.
This is where it gets fascinating because there is a total disconnect.
A huge one. I was looking at the Alpha Vantage weighted sentiment score. It is sitting at negative 0.10. That is mildly bearish.
So wait, the stock is near all-time highs, revenue's up 55%, margins are expanding, short squeeze potential is there, and the news sentiment is bearish.
That is the discrepancy. Why? Because the analysts and the algorithms are looking at the valuation. Most of the recent articles are flagging the price. They were saying, great company, terrible price. The discounted cash flow models are flashing warning signs.
So it's a valuation concern, not an operational one.
Exactly. The bears are arguing that at these levels, the stock is detached from reality. Some models suggest it is about 12.3% overvalued. They peg the intrinsic value around $405. but it's trading at $455.
But then you have the bulls like Bank of America naming it a Q4 earnings winner. They're looking at the AI integration and the broader market recovery.
And don't forget the institutional flow. The S&P 500 inclusion drove a lot of accumulation,
Right.
but it's paradoxical. You have hedge funds betting against it with a short interest, while index funds are forced to buy.
It's a tug of war. The price is rising despite the smart money trying to short it.
And then there is the rumor mill. What are you hearing there?
There is speculation about further integrations with Odessa. Now that they own the physical auctions, there are rumors they might use that new capacity for M&A mergers and acquisitions in the wholesale space.
So becoming an even bigger juggernaut.
Exactly. It would make them the central nervous system of the used car market.
Okay, I have to play devil's advocate now. I can't let you get away with just the good news. Let's look at the risks. Because if I am a listener holding this stock at $455, what keeps me up at night?
Well, you touched on it, but we need to dive deeper into that valuation stretch.
Let's talk multiples. The PE ratio price to earnings. It is sitting around 99 to 103 times earnings.
Which is high.
High. It's stratospheric. Just to frame this, a PE of 100 means at current profit levels, it would take the company 100 years to earn back your investment.
Right.
A fair value PE for a growth company might be around 38x. We are trading at nearly triple that.
So you are paying a massive premium for future growth. You're paying today for earnings that haven't happened yet.
Correct. And when you look at the DCF models, almost all of them suggest it is overvalued by roughly 9% to 14%.
This implies that the market is pricing in perfection.
That is the danger zone. When a stock is priced for perfection, any slip up, a missed earnings beat, a slight decline in margins, a hiccup can cause a massive correction.
And we have seen that volatility recently.
We sure have. I mean, just recently we saw that 14% drop down to $410. That happened fast. This stock is not for the faint of heart. If you can't handle a 15% drawdown in a week, this isn't the trade for you.
Yeah, and operationally there are risks too. The used car market is cyclical. If the economy slows down or if interest rates stay high and people stop buying cars, their growth could cap at like 2%.
Right. They are sensitive to the macro cycle. And at 100x earnings, a cold could look like pneumonia to the stock price. That operating leverage works both ways. If sales drop, profits vanish fast.
So the execution risk is real.
Okay, we've looked at the rocket fuel and we've looked at the gravity. Let's bring this to a close. What is the final verdict?
Based on everything we have analyzed, the fundamental turnaround, the capacity for growth, and the market positioning, I am assigning a bullish score of 8 out of 10.
An 8 out of 10. That is confident despite the valuation concerns. Give us the elevator pitch. Why an 8?
It comes down to the moat and the runway. They have a vertically integrated platform that is driving that 27% to 55% revenue growth. But more importantly, remember that capacity number, 1.5 million units.
Right.
They are selling a fraction of that right now. The expensive part building the machine is done. Now they just need to turn the dial up.
So the runway for profitable scaling is huge.
It is. And we have a major catalyst coming up. Earnings are on February 18th, 2026. Consensus expects a beat. If they deliver, it validates the whole efficiency story.
What about a price target? I'm worried about buying at $455.
I get that. But while you are looking at the current price, the models projecting out to 2027 are looking at a target of $671.
$671.
That offers roughly 40% upside from here, or about 19% annualized returns into 2027.
That is a bold call, so this isn't a quick flip.
No, this is a multi-year hold play. You have to be willing to ride out that volatility we talked about to get to that improved profitability. You're holding through the turbulence.
All right, so the verdict is heavy volatility, expensive price tag, but a massive engine capable of doubling its output without building a new factory. If you can stomach the swings, the road to $671 looks open.
That's the summary.
Fascinating stuff. It really feels like a pivotal moment for them.
It absolutely is.
Well, that is all we have time for today. I'm going to be watching that February 18th earnings call very closely.
Me too.
As usual, before we go, subscribe, like, and comment to this video to support the show. Let us know if you are buying, selling, or just watching from the sidelines.
We'll see you next time.
Thanks for listening.